It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back once again with Brooke Thackray, research analyst at Horizons ETF Management, to talk about, Brooke, something that's on your mind, and that's the rally in utility stocks, really, in Canada and around the world, as many other sectors of the stock market sag.
Yeah, no, one of the things that, all investors are trying to find out where the bottom in this market is. And one of the things I'm looking at is utility stocks, their performance relative to the S&P 500. And we've seen the utility stocks as a group, if we're using the ETF in the States, XLU for the utilities, is actually up for 2022. It's positive. And then it's been outperforming the market. Now, this is at the same time interest rates have been rising. We've got the 10-year yield today at 3.49%. So we've seen the rise in the yield, and that usually hurts utilities. So what's happening is investors are moving away from the more beta parts of the market or higher risk parts of the market and they still want to stay invested in the market. And they're moving into some of the defensive sectors, including the utility stocks. And we're seeing this outperformance. We saw it starting back in 2021, late 2021, the utility stocks starting to outperform in December. And we're still seeing that now. So why this is interesting is if we start to see utilities underperform the S&P 500, that could be a good sign the market might be finding a bottom at this point. But so far, that hasn't happened. Investors really want to be in the market, and they're still moving into the utility sector. And
we're looking at one of the big U.S. utilities ETFs, the ticker symbol XLU on the New York Stock Exchange ARCA index, the so-called SPDR Utilities Select ETF. And viewers can see that over the past year, it's been volatile, but it has clearly moved higher and is trading close to a 52-week high. Now, Canadian utilities ETFs also have moved higher over the past 52 weeks. It's a fairly obvious narrative. Obviously, many utilities stocks are dividend payers. The fees that utilities companies charge are regulated, so they're protected on the downside as well. Correct, Brooke?
Yes, investors are really looking to be defensive. They're looking for the stable stream of income from the dividends. And they're saying, well, I want to be in the safer part of the market, and I'll take that stream of dividends at this time. And when the market settles down and starts to find a bottom, then they'll probably shift back to, information technology, et cetera. But right now, what's key on their mind is just, they're saying, well, where do I go? And, most assets, whether it's gold, whether it's bonds, and most sectors of the market aren't doing well. And so they're hiding in the utility sector. It's a hiding place. And it's really fascinating to watch the sector perform so well when interest rates have been moving higher, which is not the typical case.
Right. I was going to ask, is this typical in down markets? Now, in other down markets, we had very low interest rates, didn't we? And other down markets in recent history were not characterized by rising rates. That's what's different this time.
Yeah. So also, too, as well, sometimes you'll see the utility sector benefit from when the market just goes down as well, even in a rising rate environment. But what we've seen with utilities, it's actually been outperforming sometimes when the market's been rising and interest rates have been moving higher. It really shows the magnetism of the utility sector so far. And it might not last. And it's probably a good signal, one of the signals as far as the market goes. And when this relationship starts to break down, that will indicate that investors are starting to be more comfortable with risk and moving into growth parts of the stock market.
Is it possible to make an educated call on when the utility sector is getting close to a top?
That's a very difficult one. We look at relative strength scenarios between the different sectors. Also, we look at it from a seasonal perspective. The good news is the utility sector tends to start to underperform in early October. It doesn't mean it's going to happen this year. And the utility sector relative to the S&P 500 performance is one indicator. You can't rely necessarily on just one indicator in the market. But we could see that if on a seasonal basis, and we start to see investors really bake in the Federal Reserve interest rate hikes, we could start to see the utility sector start to underperform starting sometime in October, which would be good news for the overall market.
Seasonality is something you pay a lot of attention to. You mentioned that utilities typically underperform in the latter quarter of the year, the October, November, December quarter of the year. What's the narrative there? Is there a reason for that?
Yeah, basically what you see is also U.S. government bonds tends to underperform. You tend to find that investors start to become more have a higher risk appetite in the last quarter of the market. And that's why, on average, we're talking seasonality. On average, on a seasonal basis, the market tends to start to settle down and start to rally, usually towards late October. We've all heard of sell in May and go away. The other side of that is getting into the market in late October. And as investors start to become more comfortable with that scenario, they rotate out of, consumer staples, out of utilities. Is a typical seasonal pattern that plays out. Maybe it's a little bit earlier this year, maybe it's a little bit later, but it is something to watch out for.
Brooke Thackray.